Hi and welcome to this week's Value Investing Video Insight. I'm going to talk to you today about two things. I'm going to give you a company that we like and explain its impressive performance. And I also want to talk to you about something much more enduring than even an individual stock investment. To begin with, I want to talk to you about what we've discovered on our trip around the major cities of Australia, talking about our new fund. I've been greatly encouraged by the feedback that we're getting from asset consultants and rating houses, and specifically a change in mindset that seems to be occurring in the investing industry. Quite specifically, I think investors have been given a dud deal over the last 7 years, or perhaps even longer. And let me explain why I think that. If you look at this chart of the All Ordinaries or the ASX 200 index, you can see that between 2005 and today, the index has produced no net gain. You can also see that there's been massive volatility. So investors have endured extremes of highs and lows with no net benefit. The result is that they're leaving the stock market en masse. And of course, Wall Street sells what Wall Street can sell. And that means that Wall Street is now suggesting that you can't stomach this volatility, and there's no point because the returns are so low. Given that you're retiring, you should be looking at income products and annuity style products. Challenger has become a top 10 fund manager in Australia by pitching to investors an alternative to stock market investing that appeals. But I think there are some fundamental reasons why investment returns have been so poor. It's got to do with the index itself, and it's got to do with the structure of our industry. Both of those things can change. In terms of the index is invested in companies that are big. Have a look at the intrinsic value of Telstra here. Or have a look at the intrinsic value of Leighton's. And the intrinsic value of Boral. And the intrinsic value of Qantas. The intrinsic values of all these companies have gone sideways over the last decade. These companies have added no economic value. And as a result, because they're big components in the index has gone nowhere too. The secret is to stop tracking the major indices and start thinking about building portfolios that are made up of high quality companies bought cheaply, rather than big companies. Big is not always good. I'm encouraged because in the last couple of weeks, the rating houses that we've seen and the asset consultants that we've seen are starting to come around to the idea that it makes sense to have higher tracking error compared to these indices. It makes sense to give the fund manager the right to switch from shares to cash. This is something that has to change. Making fund managers, forcing fund managers to be fully invested in the market, even if they don't like the companies they're forced to buy, makes no sense at all when investors care more about the preservation of capital rather than tracking error. The company I want to talk to you about today is Corporate Travel Management, a small travel management company or travel agency that focuses entirely on organising the travel for corporations and their staff and employees. We bought shares in Corporate Travel Management prior to them announcing their full year results for 2012. And the reason for our enthusiasm was quite simple. We'd seen Flight Centre's results and we'd seen Webjet's results, and we own those companies as well. And their results were spectacular. We had no reason to believe that this very high quality company was not going to enjoy the same result improvement as Flight Centre and Webjet. Corporate Travel Management is a small business, but it's been around a long time. In fact, it's been in existence for 18 years. And in actual fact, the numbers since its float have been absolutely spectacular. And I'll go through them now. Since 2010, revenue has grown by 42% per annum compounded. EBITDA has grown by 76.5% compounded. Return on equity remains at a very attractive 40%, up from 32% in 2011, and earnings per share have grown by 54%. Corporate travel management is a business that's heading in the right direction. And before you think it's actually matured in Australia, remember it's only got 9% of the market here in Australia, and it is expanding in the United States. I see no reason to believe that it won't succeed in the United States because the market there is fragmented and corporate travel management has demonstrated that its technology works very well. If it can replicate what it's doing here in Australia in the United States, then the sky's the limit. But of course, we're not paying for blue sky. We're only interested in buying good value based on our estimates of intrinsic value. Currently, the share price is trading a little bit higher than our estimate of intrinsic value. However, we have no reason to believe that that intrinsic value won't rise dramatically in future years. Many investors may in fact push the share price of this company down if the Australian dollar falls, and I believe that that could be a long-term opportunity for investors interested in high-quality businesses trading at a discount to their intrinsic value. Please bear in mind that we own corporate travel management in the Montgomery private fund, and I think it's important that you understand that if you rushed out and bought shares in this company, that you would be benefiting us. So please keep that in mind, speak to your advisor and seek personal professional advice. I hope you've enjoyed this week's insights, and I look forward to talking to you again next week.